Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management. And my co host today is Jeff Watkinson of Watkinson Capital Advisors, and they specialize in Muni Bonds. On this show, Jeff and I will ask each other some questions related to whether how you can invest in Muni Bonds or your retirement savings. Our goal is to expose you to thoughts and ideas you might not have considered prior to the show. So, hey, let's get started. Jeff, how you doing?
Doing well, Mike. Good afternoon. How are you?
Hey, very good, thank you. Yeah, we have a viewer question. Let's start with that. This is from Reed Martin in Philadelphia. And Reed is asking, what is the percent of companies that go out of business in the United States stock and bond markets in a year? Well, I'll take that on the stock side if you can answer the bond side in a minute. But really, I mean, a lot of companies do go bankrupt, tens of thousands per year. But if you're looking at the major indexes, the S&P 500, for example, you get very few. Last year, for example, none went bankrupt. In the financial crisis, you had a few, but for the most part, it's very stable because these are the biggest companies in the country. You don't see a lot of bankruptcies on that front. What do you see in the bond market, Jeff?
Good question, Mike. I'm going to focus specifically on the investment grade rated bond portion of the corporate and the municipal bond market. Obviously, if it's below investment grade or non-investment grade, there will be more defaults. But if you buy, Moody's is one of the rating agencies, and they did a study going back to 1970, and for U.S. investment grade corporate bonds, the bonds you'll find in the S&P 500, like you just discussed, the cumulative average default rate over the last 50 years is about 2.2%. So that's a very small percentage. Or compare that to investment grade municipal bonds since 1970, and we're looking at default rates of 0.1%, not even 0.1%. So it's a very, very rare, and that's why munis are the second safest asset class behind U.S. Treasuries.
U.S. Treasuries, right. Okay, very good. Hey, thanks, Jeff. So now let's ask a little bit about your business and what you can tell us about bonds and bond investing. You're an expert in that. You're an expert on the muni side. But what would you recommend for someone who wants to add fixed income to their portfolio? Should they go into a bond fund? Should they buy municipal bonds? Is there a reason they should be buying the safest, the treasuries, instead of the munis or corporates? What's your overall view on that someone what should they do and how should it vary, I guess, depending on who the people are? What kind of fixed income investment should they make?
Yeah, it really depends on the client and what their purpose is for the investment. U.S. Treasuries are the safest investment on the street. Even though the U.S. government's $35 trillion in debt, it is still the safest in terms of.
They can print their own money, so they can pay back their bonds by just making more money to pay them back. You and I can't do
right,
that.
Mike.
Yeah,
That's exactly right. Investors will look at municipal bonds. If they are in a higher tax income bracket because the interest is tax exempt from federal. If you buy an in-state bond, if you're a New York resident, buy a New York Thruway, which is a municipal bond, that interest will be triple tax exempt for a New York resident. But if you're in a lower tax bracket, it might make more sense to buy a U.S. Treasury or CD that's FDIC backed.
Is there a general cutoff point in tax bracket where it would make more sense to be looking at the munis versus looking at a corporate or government bond?
It's a very basic ratio showing. It's called the Muni to Treasury ratio, and it compares yields, and that ratio changes all the time. Interest rates go up, munis sell off, their yields go up. Munis and treasuries, they don't work, they don't move in lockstep, and there can be imbalances. I mean, currently right now, munis are a little rich compared to a comparable treasury. They tend to trade around 80, 85% of what a treasury yields. And the assumption is you're paying more than a 15, 20% marginal federal tax rate on that money.
Mm-hmm.
So there is a calculation to figure out, does it make more sense to own a muni, depending on your tax bracket? And that's something you got to work with your advisor with and work with your accountant with. But it's not difficult to figure out where that number is.
And just to answer that question a second, so the working with the advisor or counselor, so do you serve as an advisor to these individuals buying the bonds, or do you serve as an advisor to their advisors?
Great question. We do both.
Okay.
There's two parts to our business. We work directly with clients specifically for municipal bonds. And it's people who want to get their money out of a CD. They're in a money market. They have $1 million or $2 in a checking account just sitting there, money they don't need immediately. And then we also do sub-advisory work for other RIAs because the municipal space is complicated, it's labor intensive, and we do sub-advisory work for those RIAs, a couple family offices, and that's a big part of our business as well as a trusted sub-advisor in the space.
Okay. So is roughly got kind of back to answering that first question. It seems like somebody probably is in the 20 mid 20s to 30 plus tax bracket. I mean, especially if the ratio right now is in the 80-85% range, they need to be in a pretty high tax bracket to make the after-tax effects from the munis exceed or approach what they are on the governments, maybe.
Yeah. I mean, the way we look at it, like say you're in a 25% tax bracket and you're a Pennsylvania resident, that's a 3% flat tax, 3.07 state income tax, plus any federal, state, and local. So if you could earn, say, 4% in a municipal bond, you divide 4% by the federal of 25 plus the state income tax of 28. Divide that, by subtract one from that number, and you'll get a number around 6.25, 6.5. And if the credit quality and the structure is the same, and you can't earn more than 6.5% with a taxable corporate, that's where the municipal bond at the margin would make more sense for you. It's called a tax
Right.
equivalent yield.
Okay, and that's the number really. They need to look at that tax equivalent yield on on the bonds.
Yes, sir. It's
Yep.
like, in
Yeah.
business school, you learn everything in business is at the margin, and that marginal incremental dollar of income, what am I paying taxes on? And yeah, that's where the difference is on your 1040 income tax return.
Hmm.
You'll see that tax exempt income bucket, that box, and that's what we're trying to do. Keep
Yeah.
lower income taxes.
Right. Okay. So then, now you're looking at individual bonds. Do you also look at bond funds or recommend bond funds to your clients, or are you focused on individual bonds? And is there a reason that an investor would pick one over the other, like a bond fund, which seems like it simplifies the work's done for them, versus a particular, you mentioned New York, throughway bonds. Is there a reason to do one over the other as a client, or which clients pick which?
Okay, I'm going to try to unpack this as best as I can. Um, there's four different ways that we can get access to municipal bonds. Number one is do it yourself. Anybody can open a Schwab account or an account at Fidelity and search for single A rated Pennsylvania Turnpike bond or Philadelphia Housing Authority. There's nothing, and you got to buy them in at least 5 bonds or $5,000 at a par amount.
Okay.
It can be done yourself if you want to go through the work and do it. That's just the same as going on a car dealership and searching new cars or used cars. Those bonds have been through multiple profit centers. They're priced. You're the last buyer. They've
Okay.
been through a succession of markups, and you're the last buyer. And there's nothing wrong with the bond. It's just priced for a retail sale. So you can do it yourself. I'm not even going to get into selling a bond by yourself. I can quickly do that, but
Yeah.
you can do it yourself. Mutual funds, there's a lot of really good benefits to using a mutual fund, especially if you have less than $125,000. With an investment of $50,000, $100,000, you get instant diversification, you get professional management. Um, they do all the work for you. You have exposure. Um, it's great, except for the structure of a mutual fund it's not advantageous. It's not ideal for an individual investor, unfortunately, because your capital, the investor's capital, is at risk due to the buying and selling behavior of the other investors in the fund. And that can be a huge issue when investors want to head for the exit and they
Yeah. So
all want.
that's really a liquidity issue. It sounds like where you've just got people who are rates are going up or something's falling apart, and they're looking to exit, and they're pushing prices down to below whatever would be a fair value. You're still stuck holding the bag essentially, as they're selling out and lowering the value of the fund because of their price, their selling action. Is that what you're referring to there?
That's exactly right.
Yeah.
It's,
Okay.
we call it also headline risk. People, the third week of March of 2020, when the pandemic hit and the shutdown, and people turned on the TV and saw the New York City subways empty.
Mm-hmm.
People who own the mutual funds, the bond funds, were like, "Oh my gosh, get me out!" And the municipal bond market will lock up. It happens. And if you have the individual bond, I mean, you wait for there's no rush. But if
Right.
you're in a bond fund and a quarter of the people of the other investors want to get out, the fund is going to have to lower prices to attract buyers, and you're going to
Yeah.
have
Yeah.
permanent capital loss.
And,
It's
and
horrible.
are those funds, though, are they available maybe on a brighter note there? Are they available by state then? So somebody can get their Pennsylvania fund, so they have the double taxation benefit,
Yeah,
non-taxation?
yeah. I mean, you can always reach out to us if you have $50,000 and you're a Maryland resident or you're a California resident. There are state-specific municipal bond funds,
Mm-hmm.
um, and you will be able to get more of that tax advantage, that benefit. Um, and finally,
Okay.
there's an infinite maturity when you buy a bond fund. When you buy an individual bond, you know how the story ends. You know when you're going to get your money back. You know when you're going to get your bond interest, how much it's going to be, and you kind of lose that control with the mutual fund. Um,
Right.
but
Yeah.
you know, if you
So,
want bonds in your portfolio because you have stocks or other alternative investments, and bonds have traditionally been a non-correlating asset to equities, um, I could definitely see a bond fund or an ETF playing that role as a non-correlated asset in a whole asset allocation plan. Absolutely.
mm-hmm.
I'm just saying, if your goal is tax exempt income, state specific, and certainty of when you're going to get your money back, uh, I would definitely go the individual bond route,
Okay.
which can be.
Okay. So yeah, I'm sorry to interrupt, but you were saying that. So now that's an investor that has, say, 125,000 or more to invest. And then how do you work with them in selecting the bond that's right for their portfolio, or bonds, multiple?
We need to know the state of residence. We need to know what is this money for? Do you have a child going to college in 6 years? Do you have $2 million and you want to stay rich because you have other investments elsewhere? State of residence is important, and it's really about levels. I mean, it's oh, that bond's expensive. It's a high price, not a good yield, or that bond's really cheap. There's nothing wrong with that bond. It's just it's being offered at a very cheap price, and with a million different issuers, inefficiencies bubble up, and it's really trying to buy the bond as cheaply as possible, and it just takes a lot of work. We might throw out 100 bids on bonds out in the marketplace, and 95 of those bids will be rejected or ignored. Um,
Are you buying that for your own inventory, or does that then, is that for the clients, or do you have it like you own the bonds and then when a client, you resell those to a client or they shift to a client account? Because obviously for one client, you're probably not putting 100 bids out there.
that's exactly right. It depends on what clients have bonds maturing, clients have invested more capital. Okay, we need Pennsylvania paper. We need 5% coupon paper with 10-year call protection, A rated or better. And we'll start searching. And that might take us a week, a month to find the right bond at the right price. It might be a Florida resident. There's no state income tax in Florida. We can choose all 50 states. So
Right.
that there's a lot of that. And um, we have lists of bonds, and when they come out for the bid, we throw in an aggressive bid to what we think the bond is worth and what we think we can get it for.
Okay. All right. Well, that's real helpful. I've always wondered, what your role, we've been on a couple shows here, a number of shows now, specifically, who you're serving, and it sounds like you have a broad range of clients that you can serve. You can certainly benefit the people that don't have the 125,000, but if somebody has the interest in more specific muni bond portfolio or a portion of their portfolio, you can really customize that to fit whatever the requirement is, either by maturity, as you mentioned, is it for a set purpose in the future, or just diversification in their portfolio, and based by their location, state, you can match that up with the most efficient offering at any point in time. That's a lot of value to bring.
Yeah, Mike, thanks for laying that out. I mean, we use the separately managed account chassis where every account is a little bit different based on function, state of residence. And in the SMA space, there are low cost SMAs where you're buying state specific bonds for 125, $150,000. They have computers, AI, buying bonds, populating bonds. They're really an optimized solution. We're on the customized solution
I
point
see.
where this bond you're getting 30% more yield. Well, why is that? Well, there's something in the indenture that we know about, and it's not actually a 30-year bond. It's going to be a 12 or 13-year bond. Oh, tell me more. Like that's the playground.
Right.
That's the sandbox we're playing in, and
Yeah, it
it's
requires a lot of digging in your
correct.
sandbox to really find the treasures, it sounds like.
Yeah, it's fun. It's exciting.
Yeah, yeah. Oh, great.
We love it. Mike, thanks so much for digging into that. It's a fascinating space, and it's all about staying rich and predictable income. And I'd like you to tell me more. I mean, I've read a little bit about your bio, and I want to hear more about Brandywine. And I mean, the offerings you have in the retirement space. How did you get involved with the retirement plans? And what role do you play at Brandywine?
Yeah, so uh, obviously retirement planning it's almost at the heart of every financial planning discussion that any wealth advisor somebody's going to have, and it's putting the money into IRAs or Roth IRAs or 401ks. Maybe they have a corporate pension plan, and we've always been in the alternative investment space, absolute returns, having products that weren't dependent on whether markets went up or down. And about 5 years ago, we were looking at a product that we were doing for a large family office, which has been our background for a client. And somebody in the retirement space came to us and said, "What you're doing would be a real game changer for retirement plans and the retirement industry." And let me explain why. So, what happens right now in the retirement plans is a lot of the people, it's been shifting from defined benefit, where you worked for Ford Motor Company, and there's some fighting about that right now, of course. But and they would give you a pension when you retired that you knew you were going to get a certain amount of money every month, and maybe it went with inflation and it adjusted, but it wasn't dependent on how much money you put in it. They told you how much you were going to get out. And over the last couple decades, that's really shifted into these defined contribution plans. People are really familiar with defined contribution today because most companies now have a 401k plan instead of a pension, the old defined benefit pension plan. And a
Hmm.
401k, an IRA, those all are based on how much money you put into them, how well you invest, determining how much you get out. And so it's really become important now for investors to be able to select the right funds because it's up to them in a lot of cases now that they're putting their retirement money into, rather than just working and having the company invest all the money for them and getting. So that's what we've been doing. We manage money, we manage funds, and with this big shift into 401k plans and IRAs, we were told that we had a game-changing product, so we saw it as a great opportunity.
I like it. So let's I work at a private company, but let's hypothetically say I worked at a company with a 401k plan. How would I get access to your funds? Or
Yeah, so some companies they might be set up on a big broad platform like Schwab, where they have a selection of just a lot of funds in their 401k plan that people can select from. The majority of companies, though, select the funds that are in the plan for the participants, and the employees are the participants. And they may have 20, 30 funds in that plan. They'll pick a couple large cap funds, some value funds, some growth funds, an international, some fixed income, bond funds. And then the participant has to select from those the
Mhm.
funds that they want to actually have their money invested into. So they don't really get much of a say in the funds that are in the plan that they're able to invest their money into. That's
Okay.
pretty much the way it works today.
Okay.
So yeah, I guess to answer your question, how do they get into our funds? Well, their plan has to first select our funds. They have to be in the lineup of the 401k plan for that participant to be able to look in that plan and say, oh, I want this Brandywine large cap, for example. And they can, if it's not there, they can certainly ask their human resource department, and then those people can at least then take a look into it to see what if it makes sense for their plan to change funds that are in it or to add funds that are in it. But otherwise, they really are dependent on that plan making that decision of what
Okay.
they can invest into.
Yeah. I was on your website earlier, and this line stuck out to me: reduced loss equals increased returns. What what does that mean exactly?
Yeah, right. So that's our whole underlying philosophy. If you invest into an index fund, S&P 500 index fund, you've got some great returns, especially in the last 15 years since the financial crisis. Through the 2000s, you actually had a negative return, even with dividends reinvested. But since 2010, they've been double-digit returns, low teens returns. And so people have really compounded their money and done great. The problem you have is that it took, for example, a NASDAQ investor that was in the market in 1999, it really took them until the teens, the 2010s, to get back to where they were prior to that first bear market in the early 2000s. The S&P 500 generally take, like after the financial crisis, it took a few years to get back to where people had at least back to where they started before
Hmm.
the bear market occurred. So our philosophy is that if you can reduce that loss, your recoveries can start from higher levels, and you don't need to be as aggressive, take as many risks, because you're recovering from those higher levels. It's like starting the 100-meter race on the 30-meter line. You're ahead of everybody else at that point. So that's the
Okay.
philosophy we have is based on constraining, mitigating losses as much as possible so that recoveries can start from higher levels and hopefully increase returns over time.
So we are getting the up capture. Is that what we're saying? We're getting market like returns, and how are we reducing losses?
Yeah, so this our funds, and it's something people can look at in different ways, but they're set up with three components. We get our beta exposures, we call it. So our Brandywine Large Cap Fund has 100% exposure to the Russell 1000 S&P 500, the large
Hmm.
cap stocks. But then it buys put options on a portion of that to protect the downside. So the idea is that if the market really falls out of bed, you've got some protection that if you have another financial crisis, the market's down 50%, maybe you're down 30, maybe you're down 35, but it's going to be substantially less. On the upside, the way we try to preserve the upside opportunity is then we have a third component that's a sort of a side fund within the main fund that's intended to trade using non-correlated assets like currencies and commodities and a variety of things there, using a variety of different strategies, sufficient to pay for the cost of the put protection,
Okay.
which might be 2% a year or 2.5% per year. So it's not super aggressive trading, but it's there to try to offset the cost of the puts. So that in a bull market, when the puts aren't adding value, they're just costing money, you can match that upside performance.
So obviously you're buying these puts, and when the market does go down and volatility spikes, the VIX spikes, these put options are exploding in value, literally,
Correct.
and that allows you to sell them, reduce your losses, start from a higher low.
Correct. Exactly. Yes.
If that's the way to. Okay,
Yeah. Yeah. That
I
that
love it.
that's exactly right. So that's the philosophy. It was a bit of something that was different for the industry. People hadn't been seeing. Typically, if people want to reduce risk, they do it by reducing return. And that's the only way that they've done this historically. And we just innovated something we call risk replacement that allows the fund to reduce risk in the portfolio, but has the potential of maintaining returns on the upside. But yeah, it's been working out well. Jeff, I want to thank you for the show here. It looks like we're going to be wrapping up. I did want to let everybody know that uh, if well, coming up, the next person we have here is going to be John Stanford, Executive Director of Incubate, which is a leading coalition of investors in the early stage life science ecosystems. So it sounds pretty interesting. They're developing drugs and medicines for people. They're the political arm that's lobbying for a lot of the startup companies. But we appreciate you watching Money Matters TV, where your money matters. See you next time.